You may be wondering what in the world happened to stock and bond portfolios in 2022. Why did stocks and bonds both move in the same direction, down at the same time, when we thought for sure that when stocks go down, bonds would go up? In this video, I'm going to share with you why that happened, as well as sort of a big economic picture of what's transpired that laid the foundation for all of this to happen in 2022. Hi, I'm Camille Gaines here, and on my website, retirecertain.com, I write about and talk about investing for the past 40 years or so. I don't sell wealth management services. I am a financial coach, but I really like investing. I think it's super important, and everyone should think about and like investing as well. So I get to talk about it here. Thank you for listening to me talk about investing. Okay, so in this video, I'm going to talk about why this happened with stocks and bonds. I've heard a lot of confusion. I've heard gotten a lot of comments on my channel here about this. So without further ado, let me shrink myself here and share with you why this has happened. Okay, so we're going to take a little history lesson, and I promise it won't be too boring, but we have to look at history to see why this has happened recently. And let me just say really quickly, if you find this information helpful, you like this video, make sure you click that little thumbs up below the video. It really helps my channel get to more viewers, as well as subscribe to my channel if you like the information I provide. Okay. And feel free to leave questions and comments below. I'd just love to hear from you all, what you think about this, if it's helpful, what's been unsettling about all this happening. So let me start with that history that I mentioned. Okay, so did you know that in 1981, the prime interest rate was over 20%? Now that's totally crazy. And it's crazy because we're used to interest rates being 1, 2, 3, maybe 4%. And 20% just seems insanely high. Now we have to remember at the same time, inflation was also really, really high as well. But let me stay on track here with the prime interest rate being about 20%. Now I'm just going to mention that, and I'm going to keep going, but we're going to circle back to that. And I just want to throw out really quickly too that let's just remember and think about, as investors, what would have happened if we had bought bonds yielding up to 20%, 15%, 20%. What an incredible opportunity that would have been. And I always like to say that the opportunities present themselves, and it's usually at the scariest of times that that happens. You may have heard me tell the story about my father buying the tax-free municipal bonds that were yielding up to 25% back during the same time frame. And that worked out really, really well. And he did that because he was a part-time investor. He just did this part-time. He worked really hard. We were a very middle-class family back when there was a middle class, and this is what he did. So I throw out that story simply because when we have this perspective about investing and about using our money to buy assets during certain opportunities, it really is a shift from what you're going to hear about in the rest of this video. Okay, so stay tuned. I wanted to lay the foundation for that. Okay, now, so prime interest rate, yep, over 20% in the early 1980s. Okay, so interest rates, though, have gradually decreased since then. And I know this all sounds boring with talk about interest rates, but this is why all this has happened. So as investors, it's our job as investors of our money to sort of know a little about this. Okay, and I call this embarrassingly simple because I'm not an economist. I'm really not that smart. I just like investing, and I learned that these were the things that affected my investment returns. Not necessarily other things that I thought, like picking the right asset allocation or the right financial advisor. These are the things that drive investment returns. So these are the things that I wanted to learn about, and I've spent a lot of time learning about and studying. Having said that, I'm no economist, so this is embarrassingly simple. The good thing about that is everybody can understand it. Okay, So those interest rates came down from that over 20% level. They gradually decreased over the next 40 years. And so you may be wondering, well, why did that happen? Okay. So I don't want to get ahead of myself. That happened because it could happen. Okay. So a number of things happened and that were challenging in the financial markets. And the Federal Reserve was able to lower interest rates in order to stimulate the economy, in order to solve problems. And so whenever they needed to, the Federal Reserve would lower interest rates. Politicians did things that further stimulated the economy. And this happened over a long period of time, because who wants to be the politician that says, we're not going to do this anymore. We can't do this program or that program because we don't have the money. So more and more money was printed and interest rates were lowered, and gradually those interest rates came down over a 40-year period. And guess what happens when interest rates go down? The price of bonds goes up. And then, well, I don't want to get ahead of myself. So let's just talk about this a little bit more. Why does that happen? Okay, let's pretend that I've bought a bond and the interest rate on it is 5%. And that's the stated rate on the bond. And I realize most people buy funds now, but we're just going to say they bought individual bonds because it works the same way. Funds are just groups of bonds. So let's say that then interest rates rise to 6%. Well, the value of my bond has gone down. So the price of my bond is going to go down because interest rates went up. And new investors can buy new bonds with higher interest rates, that 6% higher interest rate. So the value of my bonds went down. And this is super, super important to remember and understand in the context of why stock and bond portfolios tanked this year. The next thing that we want to remember and keep in mind as investors is Treasury bonds typically go up when interest rates go down, or so we thought. They've typically done that over the past few decades. Okay, so investors think, okay, well, this is what happens. I even fell victim to that myself at certain times, thinking that this has happened. This is what's happened. When stocks go down, then bonds will go up. So a portfolio made up of stocks and bonds is going to have a certain level of risk protection in it because, well, over the past few decades, when stocks have gone down, bonds have gone up. Okay, so then the next thing we want to consider is that there was this theory called modern portfolio theory developed by Harry Markowitz. And the theory was that mixing high and low return investments would result in better returns. Now, what does this mean? This means that instead of investors like you and me, like my dad who did research and read and picked out those bonds, for example, okay, we can't figure it out. We're not smart enough to do that. So instead of doing that and trying to figure out what's going to happen, sort of quote unquote time the markets, but that's not even really, I don't even consider it timing the markets. I consider it evaluating investments and making decisions based on those evaluations. But the thought around investing became, no, don't do all that work. Instead of doing that, what you really need to do is follow the modern portfolio theory and just take a certain percent of your investment capital and put it into stocks and a certain percent and put it into bonds. You may diversify within each, like international stocks and U.S. stocks and, treasury bonds and maybe municipal bonds. But those are the major two asset classes you're going to put your money into based on a certain percent. And that percent is going to be determined by some really simple formulas that were developed in the professional financial industry. And that is what became known as asset allocation. And everyone fell in love with this idea because over the past few decades, well, bonds have gone up when stocks went down and vice versa. And so how beautiful was that? Everyone loved this. It was super simple. Anyone could do it. I could do it, you could do it, investors could do it, financial advisors could do it, wealth managers could do it, funds could do it for people that didn't want to do that simple allocation themselves. So it was very, very popular. It was successful, and it usually is successful or has been historically. Remember, because all this was happening with interest rates going down, which stimulated the economy, which profits increased, so stocks went up and people made more money in their jobs, and all these good things were happening that were making stocks go up. But not only that, we had the protection of bonds, because when stocks did have to flush out and go through a bear market, bonds would go up. And then to make things even better, we were getting a fairly decent interest rate on our bonds for a really, really long time. Plus, we had bonds going up in price because interest rates were going down in price. Because remember, when interest rates go up, the price of bonds goes down, and that means the vice versa is true. So when interest rates are falling, the price of bonds go up. So our bonds were increasing in price. Our stocks were increasing in price. Who wouldn't be happy with this? Everyone made money. Investors made money. People in the enormous financial industry were making money. The government was making money because they were getting paid by taxation on these assets that increased in price when they were sold and or when companies paid dividends. So it was great for everyone involved, and this lasted for several decades. So who wouldn't love that? And everyone fell in love with this asset allocation model that some of my viewers get really angry when I talk about how, well, there's just some problems with it. And that's what happened in 2022. Hence, I'm making this video to explain all this in my oversimplified version. Okay, so let's back up just a second. Remember those high interest rates that I talked about, those over 20% interest rates. Okay, the Federal Reserve lowered them over about 40 years, and then during that time, stocks went up and bonds went up as well, for the most part, really, we could say. I mean, and all of this is a bumpy ride, right? Interest rates go up a little, they go down a little, they go up, they go up a bit more, and then they go down a tiny bit. So it's not just straight up. And it's the same with stocks and with bonds. But these are trends. These are long-term trends. And I think long-term trends are really, really valuable for us investors to pay attention to if we want to lower our risk and get better returns. Okay, so then what happened? All about the same time, all these things happened. Okay, interest rates were so low, they couldn't go any lower. So that it's not a trick, that strategy that was used to solve problems when the economy ran into problems could no longer be used, because the government could no longer lower interest rates to stimulate the economy, to do the things that they could do that would drive the economy and make assets go up. And then not only that, there was a global pandemic. And then this led to supply chain issues. And then inflation started rising because we had supply chain issues. But also inflation started rising because of all the lowering of interest rates, really more so the printing of money, lowered the value of the dollar. So when you have more of something, it's not worth as much. I like to give an analogy of chocolate cake. If you have a tiny little slice of chocolate cake, it can be delicious. But if you have the whole cake, then it's no longer really delicious. It makes you feel sick. So money is the same way. It loses value. The more you print out, the more it's available, the less value it holds. So then prices have to go up in order to make up for that. Okay. So then inflation had started rising because we had these supply chain issues, because of the global pandemic, but also because of all the printing of money, which devalued the dollar. It devalued our currency. It was no longer worth as much as it was before. And then a war began, and then supply chain issues got even worse. And so, as a result of all this, company profits began slowing. And now I'm not going in exact order, so all this sort of happened over a fairly short time frame though. And then lower profits hurt stocks because people supposedly invest in the stock market because they want to participate in the earnings of the companies that are in the stocks. That's sort of the old-fashioned way of thinking of it, and the reason we're quote unquote supposed to buy stocks. Anyway, that's a whole other video. But lower profits do hurt stocks. Rising interest rates hurt bonds because remember, when interest rates go up, bonds go down because investors can get a higher interest rate off of new bonds that have that higher rate on them. And then they don't really help stocks either. They don't help, they make it hard just in general for companies and for profits for companies because it's harder to borrow money. And so what happened is all this happened at the same time, and stock and bond portfolios, stocks and bonds went down at the same time because all of this happened around the same time, and the economics were no longer in place that could sustain that beautiful and profitable blend of a stock and bond portfolio that most investors have really, really grown to love. And investors had come to believe that stocks and bonds would never both go down at the same time because they've been non-correlated. They've moved in opposite directions for the past few decades. But in actual fact, and I did an entire video on this if you want to check it out, I have nerdy charts and data showing that over the past 100 years, stocks and bonds have been correlated more than they've been non-correlated, which is a shocker. So this is why stocks and bonds went down at the same time though, because of all these factors contributing to this. Remember, retire certain.